Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, educators, authors, traders, money managers, and in today's case, strategists. Super excited to share with you a conversation we had recently with Alicia Levine. Alicia is the head of Investment Strategy and Equities at BNY Wealth. We talked a lot about current market conditions, talked about her work with the Investment Strategy Committee at BNY, and how they are trying to navigate these markets in a very volatile period in equity market and broad market history. So please enjoy these comments and perspective from Alicia Levine of BNY Wealth. Super excited to be sitting down today with Alicia Levine, head of Investment Strategy and Equities at BNY Wealth. Alicia, it's so good to meet you. I've heard of you, I've followed your work, and it's such a pleasure to meet you in person. Thank you.
I'm so excited to be here. This is great. What an electric morning we've had.
We are doing this live from the Money Show. We are going to talk a little bit about what you were doing at BNY Wealth Management, kind of approach it. I want to talk a little bit about process, but I want to start out. We just came from your keynote talk, which I think the phrase was, "Is the U.S. economy exceptional or vulnerable?" So which is it?
So, in a word,
let's start there.
Exceptional.
Okay, good. Yeah.
And the second part was, and we're not in a bubble.
Okay,
so
right.
There's
Okay.
two pieces. So everybody, take a deep breath, relax, exhale. The fundamentals favor investing in the U.S. over the long term.
Yeah, right.
Yeah.
So what would you say to people? Because obviously a lot of people are struggling with the fact that this market has had the run that it's had. People start talking about valuations, talking about things feeling overextended. How high could it go? We haven't had a pullback. What do you say to calm the nerves of people that are feeling that anxiety here in October of 2025?
So it's very normal to feel that when the market's at an all-time high, and we've had a particularly interesting run. I mean, the S&P is up almost 40% since the lows, and NASDAQ's up about 50% since the lows. This is actually historic. And we do make daily highs, and we have, finishing last week. We get the question all the time, should I wait? What should I look for to invest? And the really interesting thing, of course, is that investing, we did a study about investing at all-time highs versus investing on any other day.
Yeah.
So
interesting.
Yes, we took all the all-time highs, and we then projected forward the 12-month returns, the 3-year returns, and then the 5-year returns of investing at all-time highs versus investing any other day.
Okay.
And it turns out you have positive returns in both, and they're slightly better when you invest at all-time highs on the 1, 3, 5 forward outlook, because part of the reason that assets are at all-time highs is the outlook is good, and the economy is strong, and earnings are strong, and markets always look forward. Really important. They don't look backward. Markets price in the forward 12-month outlook. So you can get caught in a downdraft. It does happen. But if you smooth it out over 5 years, there's always a good time.
Don't be afraid of new highs is what I'm taking away from this. Okay.
Don't be afraid. It's a natural question to ask. And so we did a study to show why.
Actual data to back this up. That's brilliant.
Data.
Okay,
it's
good.
a fabulous slide.
Yeah.
And really it shows that, look, when you're investing when fundamentals are fine, and they've been great, really, for, 40, 50 years, investing in U.S. businesses, who doesn't want to do that? So, you're protected by the strength of the economy and by the businesses. And there are always dislocations. We had policy dislocations earlier in the year. The market dropped over 20%. That can happen too. I don't want to sound Pollyanna-ish, like it's only a straight way up, but we always look 12, 3, and 5 years ahead.
The long-term time frame is certainly what's going to help that for sure, right? And I feel like a lot of investors get caught up in the short-term flickering ticks and forget to do long-term. What sort of, what would you tell the people, or how do you help people sort of not get too sucked into the short-term movements? Because it's super tempting. One down day last Friday, everyone gets very nervous.
It was only 3%.
It wasn't much, right? But how do you stay focused properly on the right long-term time frame?
So I have a couple of things that I tell our clients. The first thing is that the noise is noisy. The headlines are very noisy. It doesn't matter which news you're reading or watching, it's noisy. And it's creating a lot of anxiety for people. So the first thing we say is you have to ignore the noise out there. And in the end, what happens in the real economy is less important for asset class appreciation than the fundamentals of corporates and the market. And what we know is that earnings estimates are moving higher and have been moving higher since April. And that's part of the reason you've had a huge return in the S&P from the lows, because in fact we did not fall into recession.
Right.
In fact, the worst did not happen to the corporate sector. The tariffs are being absorbed by corporate America. There are some issues there. Not all sectors are going to do as well as others, and we can talk about that.
Yeah.
But overall, the worst fears on April 3rd, when the market fell, about 20% from high to low, that the fears of recession just didn't happen.
Yes.
So you have to really think about the fundamentals in the market. You lose money if there is a recession, because then the drawdowns can be 20 to 30%.
Yeah.
But over time, if again you smooth it out over 3 to 5 years, it's a great time to invest.
It's fair. All right, so
hard to do.
Yeah, so the Federal Open Market Committee, we always talk about the dot plot, right? Sort of where their expectations are. So I'm going to ask you. You don't have to give me any proprietary information, but you are the chair of the Investment Strategy Committee. I'm curious, when you guys have gotten together, you get together once a month, right, to talk about strategy. I'm curious about two things. Number one, what sort of consensus is there when you're talking to your fellow committee members? I mean, is there a general, this is obviously good, or are there certain areas, maybe certain asset classes where things feel more risky than others? And number two, what sort of consensus is there? Is there agreement, or is there disagreement? If you can share that.
So, a lot of it is, I'll share what I can share, which is that, we have a very robust committee with robust conversations. Yes. And I actually try to bring in outside speakers who may disagree with us.
Oh, I love it.
Because, I have an academic background, as you know.
Yes.
And then one of the most important things is not to be in an echo chamber where you're only talking to people who agree with you.
Yes.
So it's very important to test your assumptions and to test your theories with people who really disagree with you. And I think that's made us better for four. I'd say overall, our areas of our agreement are that over the long term, investing in the U.S., whether it be large, small, or mid cap, is going to likely outperform other asset classes over the cycle, even when you get a policy dislocation like we did in April with Liberation Day and the talk of, American exceptionalism is dead. And there was heavy talk, do we move more into international? And again, we always look at the forward 12 month. Where's the market from here?
Yeah.
So I'd say those are the flavor of the conversations. We are looking at other asset classes. We are talking about everything that everybody else is talking about it.
Yep.
But we do it with a view, not for trading, but for building wealth. Because we do this for generations.
Yeah, right.
So our view is 12 to 18 month forward outlook. But then, if we have to trade this, do we actually want to make the trade? Because we're going to give our clients a tax event, and then we're going to have to undo it 12 months from now.
Yes.
And so it's not just pure performance, it's also what are the tax implications. So we try to be sensitive to all that.
You hit on a really good point there about the echo chamber, and I think, to be honest, Alicia, I think that's where a lot of individual investors get into trouble with things like social media. It immediately just reinforces whatever biases you have. You're liking a bunch of things that sort of keep feeding that. I wish everyone had that advantage, being able to compare notes with others. Tell me a little bit, we're completely flipping the agenda I had laid out, but this is fun. Tell me this, you mentioned your academic background. Talk to me a little bit about your transition from academia. What area of focus did you have? What was that transition to more of an investing role? Those are two very different worlds in the financial industry. Talk about that transition. What did that mean when you look back?
Well, first, let me just say, thank God I left academia and went to Wall Street. It's just the only thing I'm going to say.
Okay.
So I was a nerd.
Right.
And I love learning things, and I just kept on going till I have a PhD in political science, actually, from the University of Chicago.
Okay. And
one of the great things about the social sciences at the University of Chicago is that it's really suffused with all the understanding from the economics department.
Right.
Because it's one of the greatest economics departments
yes,
in the world.
For sure.
And so even though I majored in political science, we did game theory.
Yeah.
We used a lot of the methodology that they use in economics. So it gave me a great background.
Right.
I left academia because, I just needed a little bit more adrenaline.
And that wasn't scratching that itch for you?
In my field, you wrote a book, it took 7 years.
Yeah.
And I
it's
needed
the
more.
long game.
It was really the long game.
Yeah.
And so I took a research mindset
okay,
and an inquisitive mindset, asking questions. And I just applied it to companies and asking CEOs questions and
Yes.
CFO, and asking them questions they weren't expecting.
Yeah, right.
And so I loved it.
Yeah.
I had the adrenaline. I got to put my theories into practice every
Yes.
day with client capital.
Yeah.
And so that's how I made the transition. I've never looked back, actually. It's been a
Yeah.
fabulous career, fabulous colleagues. Some of the smartest people in the world have been in this industry, actually.
It's so fascinating. I feel like for a lot of people trying to make that trend, I mean, it's rare that someone does it successfully as you have. But academia, I mean, it's a lot of theory. It's a lot about what the market should do, and then you're transitioning to what the market's actually
and you're
do.
angry when it doesn't. You're
Yeah.
angry when it doesn't. Your theory is
yeah.
wrong, and like you're angry. But the truth is, as you know, to be a successful investor, you
Yes.
have to listen to what the market's telling you.
100%.
So you may have a theory about stagflation,
Yes.
and you may have a theory that the U.S. is going into recession because the tariffs are going to shave $700 billion out of the economy,
Yes.
as we feared in April.
Yeah.
But when the tariff policy changes, maybe you should change your theory. and when the market is up every day,
Yeah.
then, and I'd say this, that 10% day, when the S&P was up 10%, I think it was April 9th, maybe April 10th,
Yeah.
that was the signal that the fears were over. It was a massive surge,
Yes.
90% up, down day.
Big swing.
And
Yep.
that's the market telling you, if you thought we had stagflation, you were wrong.
Yes.
And it's okay to get in then.
Yes.
So we try to take the environment into account, besides trying to build good theories.
Alicia, I know you're not a big technical analysis aficionado, but I give you an honorary technical analyst designation for making a comment out about the message of the markets with the price surging off the lows. Thumbs up on that. That was well done. So, University of Chicago in particular is known for being, background in quantitative strategies and things like that. How did the time there, particularly on the quantitative side, has that informed how you approach things today? Are there more statistical measures that you use, or is it more subjective, more broad, thinking about all the different relationships, or a little both?
It's a little of both. I'd say it was very good at unpacking data.
Yeah.
Like if I looked at healthcare companies, biotech companies, just looking at like their clinical trial data, I was very good at knowing what was what was not a good outcome. But also, I think the notion of like, you put bad things into the beginning of your theory, you're going to get bad things on the out. You're going to get bad outcomes.
Garbage in, garbage out, right?
Garbage out. I think that framework is so important. I'm going to go back to tariffs and stagflation again.
Yeah.
Because why didn't the U.S. go into recession? Why isn't inflation running away?
Yeah.
Because we only looked at one variable. We only looked at what, the 1930s told us the tariffs did to the industrial U.S. economy. By the way, we're not an industrial economy
Not
anymore.
even close, right?
And so what it didn't take into account, this is actually a dynamic model.
Yeah.
And that's what I learned at Chicago. So, for instance, we have the One Big Beautiful Bill. It actually gave over $100 billion to corporates at the end of September, kind of sterilizing the tariffs that they were paying. And at the same time, we're supporting the consumers of $160 billion in the first quarter of the year in 2026 through the tax code. So the tax code is actually supporting the corporate sector and the household sector. This is the reason we didn't go into recession, because we had the tax bill sterilizing it. If you only looked at what tariffs do to an economy, you would have a very different outcome than if you looked at like a multivariate model.
So, and isn't that one of the biggest mistakes I think people would make, is they tend to think very, they think of things as a very simple relationship.
Yes.
If this goes up, if stocks go up, gold should go down, blah, 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 blah. And market history has been filled with times when those simple relationships totally break down.
And by the way, the most dangerous trades are the most crowded trades.
Always, right? Yeah.
Always.
Okay.
Always.
All right. So speaking of crowded trades, we have a benchmark issue here, a very top-heavy benchmark. I think latest when I was looking at the data, top 10 stocks are about the same as the bottom 450 in the S&P in terms of weight.
About 38 to 40%.
Yeah, that's big.
It's big. But the earnings power is 32%, by the way.
So the earnings arguably justify it? Is that the argument?
I think that is the argument. Yeah. I'd say that the earnings power is commensurate with the market cap weight.
Yeah.
Obviously, if something happens to the earnings power of any of those top 10 stocks, that's where you're vulnerable.
Yes.
Right? So when you have a theory of why it's working, you have to also say, okay, if it doesn't work, what am I looking for? And we'd be looking for, do we have declining earnings? Do we have declining margins? Because part of the reason we're sustaining a 22 times forward multiple is that the margins are so much higher than they were 20 years ago.
Yeah.
We're just in a higher margin world, and we've had the margin walk for the last 20 years.
Yeah.
So something happens to those margins, whether it's the tariffs or so much CapEx spend, then you have to start thinking about your forward multiple. So those are the things that we're worried. Like, that's what we look at. That's what we would focus on.
Yeah.
I'm worried less about whether GDP is 1.5% or 2.1%.
Yeah,
Just worried much less about that.
Okay, so just in a short conversation, we've talked about tariffs. We haven't really gotten to inflation. We've kind of teased around it. We have the Fed. We have an administration with, a rapid changing in policy. When you think about all these different things, with the backdrop of the equity markets doing so well, what's like the biggest tail risk? Like, what's that thing that, if you do stay up at night, what's the thing that worries you? Is there one thing that stands out that you think people should be most attuned to?
So, look, I think it's a great question. I think that massive policy changes don't come without shocks, right?
Yes.
I think March, April was an example.
Good example, yeah.
A great example.
Yeah.
Like, your assumptions about how economies work and how corporates work overnight was scrambled. So policy shocks, and I think this is an administration that wants to enact massive policy changes. So I think more policy changes along that way could induce volatility in markets. I'd say one of the things we talk about all the time are the deficit and debt. It's interesting because annualized, the tariff revenue is bringing in about $370 billion to the U.S. Treasury.
Right.
That's helping on the deficit side. It's also helping on the 10-year yield side because the deficit isn't blowing out. It's kind of an inefficient way of doing things. It also means that future administrations are likely to have to keep the tariffs unless they're willing to cut spending.
Sure.
I haven't met a politician yet that wants to cut spending.
No.
So I'd say there's that complex is something to be keeping an eye on.
Okay.
AI spending, interestingly, also $370 billion a year. So you've got tariff revenue coming in at 1%.
Right.
You've got, the tech sector spending 1% of GDP on CapEx. So it's the spending that's how. Could we get work? We printed 3.8% GDP in the second quarter. A lot of that's the CapEx. Yeah, it's interesting. It's a dynamic model. It's not just one thing.
So earlier in your career, you made a transition from investment management to private wealth and wealth management, and maybe more of a connection to individual investors, families, people actually trying to put money in and create generational wealth. Can we talk a little bit about precious metals, which have done remarkably well, gold pushing above $4,100 an ounce, while other risk assets are doing quite well? So I guess a two-part question. How do you think about gold and precious metals as part of a larger allocation? And how do you think investors should be thinking of it, given the fact that it's had a run already? And I think some people may be nervous about having exposure here, given the fact that it's had a run. Talk to us about the precious metals trade.
It's up about 25% since September 1st.
It's a big number.
It's a big number. Like, I think we just want to point out part of the reason that gold has had such a run is that central banks are buying it for their reserves.
Yes.
So when the U.S. sanctions Russian assets, the Russian central banks, China noticed it pretty quickly.
Yeah.
And so China is now buying gold. India is buying gold. Other central banks are buying gold. I call it the nations that might worry about being sanctioned at some point are buying gold. So there's like a natural bid under it, separate from the inflationary piece.
Yes.
Okay, there's just a bid under it. Look, it's been a fabulous asset. We have a commodity exposure in our overall model portfolios of all risk appetites. I just think that when assets run that far, that fast, we do think gold likely goes higher because of the bid from central banks here.
Right.
Every central bank is cutting in a world where their deficits are growing. Look at Europe. Look at France, Germany, UK, right? The U.S. is not alone in this. And so it's a world where countries cannot get their fiscal house in order because of the ballot box. And so very difficult decisions. And as a result, gold is getting a bid. Do we think it goes, as I said, we think it goes higher, but it can also correct, right? It's just, it's gone up so much.
What do you make of, in terms of non-U.S. markets, there's obviously been stretches in 2025 where developed Europe, Asia have done way better than the U.S. Weaker dollar has been a big part of that story.
That's almost the entire part.
Story.
That's the story. The story is the weaker dollar.
So now, given the fact that the dollar has weakened so much, what do you see now? If you've missed that trade outside the U.S., is it too late? is there still a decent amount of exposure you should have there, and why?
So we always have exposure to all asset classes within fixed income and also within equities.
Okay.
I think what's happened to a lot of people's overall asset allocation is that as the U.S. exposure grew so much over the last 15 years, nobody rebalanced. I think this year was a reminder to rebalance. We see U.S. assets and U.S. fixed income, corporates, high yields, govies, as well as equities as sort of your core exposure.
Yes.
I'd say other asset classes are more like satellites, but you want exposure to the developed international. We like emerging markets here, both debt and the equities because of the weaker dollar. You should always have that balance. The truth of the matter is, this is the first year in 15 where you're really paid to do that.
Yeah.
Right.
Yeah.
In the other years, it was a drag on your portfolio.
Yep.
And so a lot of clients have decided, it's very hard to convince, well, you really should be
100%.
allocating. I'd say it's a good reminder. The U.S. dollar trade is mostly responsible for the U.S. underperforming rest of the world.
Right.
I'll just say this. The dollar has been flat since July 1st.
It's true. Yeah.
Right? Okay,
Yeah.
it's done nothing.
Look at the data.
Look at the data. And also, the level of the dollar index is pretty much where it was 3 years ago. So, it's really good to, turn off the TV and just take a look at a long-term chart.
I love it.
So, let's say the dollar weakens 2 to 5% from here.
Yeah.
Well, that's pretty good for revenue for the S&P because 40% of S&P revenue comes from overseas. So a weaker dollar means higher revenue. Your other asset classes will do well. I'd like to see the rest of the world stabilized. So that's not such a bad thing. It's good for all asset classes. But you should always be diversified because you do get years like this. And you want to just dampen down the volatility.
Alicia, one of my favorite quotes is, when in doubt, zoom out. I think that comment about the dollar is spot on, right? When you take a step back.
I like
you
that
can,
one. I have to
yeah,
use
keep
that
that one. You can use that.
I love it.
Alicia, this has been awesome. I hope this is the first of many conversations we have, but I'm really thankful for this one. Thanks for joining me on the show.
So great. So I've been listening to your podcast to prep for this. So I'm so glad you brought up the technicals because I love technicals.
There we go. It's on record. We have it on camera too. Thanks for that. Listen, great to meet you. Have a good trip back to New York, and we'll see you again soon, right?
Thank you.
It was a great discussion. I hope you enjoyed that conversation with Alicia Levine. By the way, I should share, before we went live, I always ask my guests, how do you pronounce your name, just to make sure I get it right. I like to hear how they, describe it instead of me butchering it and then telling me. And, her name, Alicia Levine, actually could be, pronounced a couple different ways, right? Depending on how. And she said, her answer was just awesome. She said, Alicia like Alicia Keys and Levine like Adam Levine. I thought that was awesome. And I got it right, I'm pretty sure. But Alicia was just an absolute pleasure to meet, to get to know, and to chat with. I wish all interviews on the Market Misbehavior podcast were that easy, because it was easy to get into a lot of really fun topic areas with Alicia. Really interesting. If those of you that have not worked at large financial institutions, when I asked her about, serving as the chair of the Investment Strategy Committee, one of the things I miss, and I don't miss everything about working at a large financial institution, let me be right up front with that, but there are certain things that I miss, and being surrounded by smart people who have studied and are educated and have great experiences through the markets and working at different firms, and being able to get that group together with some regularity to just chat about, hey, what are you seeing? Oh, wait, that lines up with something you were saying. Wait, are you on the same page or not? All right, why are we disagreeing? And just being able to navigate these markets, not just on your own, but with a group of other motivated investors trying to answer the same questions for the same purpose, in this case for the clients of BNY Wealth. I think that was a little just brief window into some of those conversations that happen at firms like that, and how Alicia and her team try to navigate and try to make sense of all these events. You have to remember, you're not alone if you feel underwater with the fire hose of investment data and prognostications and news flow that comes through every trading day. Trying to boil all of that noise down into investment thesis is not easy. Alicia and people like her, I think, are very fortunate in that they have a good team around them to try to navigate things. But I thought that was really fun, a little window into what happens at a firm like that hopefully you enjoyed. Really appreciated talking about risk management, talking about allocations, talking about how to think of different areas of the market, risk assets, hard assets, risk on versus risk off, and just getting a little bit of sense of how to try to make sense of all of those things. At the end of the day, what I learned from my conversation with Alicia, and I hope you picked up as well, it's an iterative process, right? Investing is not like a moment, right? It's not one moment in time where you review all the evidence and then you make your decision and then you go do something else. It's an iterative process. It's a consistent process, ideally, and that's what we try to reinforce with all of our viewers, right? It's not about perfection. It's not about getting the thing right at any given moment. It's about consistently reviewing the evidence, recognizing when the evidence changes. And again, thanks to Alicia Levine of BNY Wealth for sharing some insights in terms of how she's been able to do that through her career and how she does it today for the clients of BNY Wealth. Thanks again to Alicia Levine joining us here on the show. As a reminder, we're always open to new faces and new voices here on the Market Misbehavior podcast. So if there's anyone you think we should be sitting down with, please let me know. I'm happy to approach anyone. I've got no fear trying to go after some great guests to share conversations with you and ask some of the questions you've been dying to ask. So make sure you drop a comment with any guest suggestions you might have. By the way, if you want to learn more about the technical analysis tools and techniques that Alicia and I teased out a little bit, if you picked up, even someone who's a macro strategist still looks at the charts, still respects price action, and wants to understand what's happening with the trends in the market. If you want to upgrade your own ability to analyze trends and identify changes in those trends, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your own decision-making process. 3 great benefits to the premium membership. First off, our virtual courses. Flight School Behavioral Investing is where we'll teach you all about behavioral finance, all about technical analysis, give you some of the tools and techniques you will need to survive and thrive in 2025 and beyond. You will also have access to all our member-only reports, like our weekly flight plan, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member community. This is a small and mighty group of like-minded investors learning from each other, asking questions. I was in there just this morning reviewing some of the questions that our members had asked and sharing some charts and insights. So we're always happy to welcome one more to the premium member community. For more information, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller reminding you, it's always a good time to own good charts.